Hi, welcome to the Interaxis channel and Interaxis.io. Today we're going to talk about a podcast that we listened to yesterday, watched it on YouTube, where Anthony Pompliano, who you might know as Pomp, interviewed Jim Cramer. Jim Cramer of Mad Money of CNBC, formerly of TheStreet.com. And what we wanted to do was talk about a few of the things and explain a few of the things that they discussed in this episode, partially because we just like explaining things. We like taking concepts that a lot of people maybe don't understand and take our years of experience in finance and the ability to explain them and give them to you in a way that you understand. Also because Jim Cramer is partially famous for magazines he had done about investing and helping educate people for TheStreet.com and for now at Mad Money, formerly at Real Money, at Mad Money at CNBC, for helping to educate investors. When TheStreet.com came out, it was among the first websites to do this, and this was at a time when online brokerages were becoming big, when the tech bubble now was happening, when everyone was investing in internet companies and they were able to do so on E-Trade and Ameritrade and such, and TheStreet.com came out with education about how to look at stocks, how to look at equities, how to evaluate them, how to understand what you're investing in, so you don't just invest because other people are doing it or because other people said to. You can make your own decisions. So that's what we're trying to do here, is help you understand how to better educate yourself and understand what was being talked about so you can make your own decisions. So we're going to talk about this episode. They went into inflation, gold, real estate, Bitcoin, of course. And so what we want to say is we're not endorsing any of this. We're not telling you to make any of these investments. All we're saying is we just want to help you understand better what was being discussed, and hopefully we can do that here. We also want to remind you, please subscribe to the channel here. Visit us on Twitter at Interaxis8. We keep coming up with new videos like this, new content, trying to educate, trying to explain to you how the crypto, DeFi, blockchain world might impact you and how you might want to look at it, so you understand the impact to you, your finances, your family, your business, your world, and that's what we're trying to do. So now we're going to go break down some of the things in this episode. So Jim Cramer and Pomp were talking about of course, the backstory of Jim Cramer, but then they started talking about different investments, different inflation hedges. And so we want to see where that fits into our portfolio, what an inflation hedge is, what some of the options are, and then go into where Bitcoin or crypto might fit in, because that was kind of the end of the conversation there. So first we want to look at what a portfolio looks like. And a portfolio is just simply everything that you own that you've invested in, right? So your portfolio includes your stocks, your bonds, your equities, your mutual funds, things that are in your 401k, your IRA. It also would include real estate, alternatives, bonds, your home, and then inflation hedges, right? So you have equities. This is stocks. This is funds that might own stocks, and stocks, of course, are your ownership in publicly traded and public companies. Okay, you have your bonds or your fixed income. This is basically where you are lending money. You're lending money to someone else and they are paying you interest for it. Okay, so this is I lend and I get paid interest. And the nice part about bonds is they pay the same interest over time. So you continue to get income from money that you've let someone borrow. Now they might not go up in value quite like equities do because the income's always the same. However, it's steady, and you need that usually in your portfolio. Here you have more growth opportunity. You're growing with the market, you're growing with these companies, but you're also subject to not only to the risks of the market, right? If everyone is getting out of equities, then the whole market tends to fall together. Plus you have the risk of individual companies. So if you own individual companies and their management is poor, something happens to their product, something happens that disrupts their product or their service or their business, you have the potential risk of each one of those companies and their management. Then you have alternatives. These are things like real estate, private companies, art, it could be gold, things like that, oil and gas partnerships, something that is an alternative. It's not in the publicly traded market. It's not where you're necessarily lending money through some sort of public bond mechanism. This is something that's usually more private, and they are usually illiquid. So you might have more growth potential, but usually very illiquid. You can't get back to cash as easily. And sometimes cash is the most important thing you can have. There's no substitute for cash when you don't have it, except to borrow someone else's cash. And if you borrow someone else's cash, you're paying them interest. Okay, and the more you need that cash, probably the more interest you're going to pay. So they're very illiquid, but they give you the ability to potentially earn more. And then somewhere in here you have your inflation hedges, and that took up quite a bit of the conversation. And that's kind of what I want to talk about, because that's where we get into talking about Bitcoin and crypto. But first we go into gold as such. So we're going to talk about what an inflation hedge is. Okay, so a hedge, to begin with, a hedge is where I am fairly certain that some financial occurrence will happen. I don't want to call it an event. It's something will happen in the markets. So it might be that I think, if I think the stock market is going to go down, for instance. So the stock market has been climbing, and I think, up here or even here, I think, my gosh, if the stock market goes down and I'm in equities, right? I'm in these equities over here, I might want to buy something in case the stock market goes down, because I think it will. So there might be something there's the VIX index, there's indexes like VXX, which is a fund that protect me. If there's volatility, if this starts going erratic, these actually go up in value. There's that. I'm in Texas, so we talk quite a bit about oil, of course. So there's oil hedges. So if I'm in the business of bringing oil out of the ground, and I get paid based on, obviously, the price of oil at the time is not something that I can always control. So if oil's $40 a barrel when I'm drilling and it comes out of the ground, and I know if oil goes down to $30, I'm going to have a tough time paying my bills, I might buy a hedge, and this might be a put option, which gives me the ability to sell my oil to someone else at $35 if the price of oil goes down farther. So I'm protecting myself. Now, I pay something for that. So instead of making 40, maybe I'm actually making 39 because I take $1 of this and buy this ability. So I don't have quite as much upside. Of course, I want the price of oil to go up. That would help my business the most. But I know that if it goes down, I'm protected and I can still run my business and pay my bills and make my money and provide for my family if the price goes down. So that's just good business, good financial sense. It works in business, it works in personal finances. That's a hedge. It's different than insurance in that insurance is protecting against usually like one big event, and I get paid a big lump sum of money in one big event that I hope never happens, right? And is not as likely to occur. So then we need to talk about inflation. And to talk about inflation, inflation is basically where the dollars I have in my pocket, or the dollars I have in my bank account, or the dollars that I have in my portfolio are not going to buy as much in the future as they do now. So let's say a dollar buys one loaf of bread today, and in a year it will cost $1.05 to buy that same loaf of bread. Okay, so that is 5% inflation, which doesn't seem like much. You go, oh, it's just 5 cents, it's not a big deal. But extrapolate that over everything. Okay, so let's say you have a $200 per week grocery bill that goes up 5%. It's now $210 a week. You go, okay, I can handle the $210. Okay, if that's per week, multiply that by 52. And so this is 10,400. This is about 10,900 and something. So now you have a $500 per year difference just in your grocery bill. Okay, and that's a $10,000 expense item for you. Okay, again, extrapolate that at everything in your life. If it costs you $100,000 to live your life, if it costs you $50,000 to live your life, figure out what 5% more is. Okay, if it's $100,000, 5% is $5,000. It costs you $5,000 more dollars to live your life next year as it does this year. The question is, are you going to earn $5,000 more dollars? Or is that just going to be an expense that comes out? And if that 5% is 5% the next year, 5% the next year, 5% the year after that, are you going to keep earning 5% more money? That's the question. That's kind of where the idea of inflation comes in. And why do we think we might have inflation, or why do we just protect against it at any point? We protect against it at any point because, well, if we go back to my example here, right? $1 for one loaf of bread versus $1.05 for one loaf of bread. So one way to look at it is it costs me more money. The dollar has gotten less valuable. One way to look at it also is the loaf of bread has become more valuable. It's more valuable now to have bread than it is to have a dollar, right? Because now one loaf of bread can buy me $1.05, right? So if I'm in the bread business, I'm good, because now I'm getting more for my money. Now it might have cost me more for the ingredients to make the bread too. So inflation can permeate everywhere. So why do we have inflation? Well, back in starting in 2008, 2009, when quantitative easing started, when the U.S. government started printing more money, it was because they said we need to get more money into the ecosystem. We need to lower interest rates, get more money out there so businesses can invest and grow. And that's actually what has happened. Businesses have invested and grown. And we haven't actually seen inflation from that. And that was, several $100 billion worth of quantitative easing, of more dollars in the system. So the amount of U.S. dollars, right, in the system has gone up. Now, with COVID and everything that's going on now and trying to help out the economy, there's something like 6 trillion more U.S. dollars in the system as there were before. Okay, so we haven't quite seen inflation just yet, but I want you to imagine there's $6 trillion, and those $6 trillion that are additional to the system are meant to buy goods and services. So there has been probably fewer goods produced now because factories had to shut down. There's probably a little less service out there. So the question is, with $6 trillion more dollars out there, are there going to be $6 trillion more dollars worth of goods and services out there to balance it out? Okay, and if you don't think there is, then the answer is there's going to be inflation. There's less of a supply of goods and services and more dollars out there to buy them. So the ratio of dollars to goods and services has gone up. There's more of them. Therefore, we have inflation. It's going to cost me more money to buy these goods and services because there is just more money out there in the world. By virtue of the fact that the government said we're going to throw more money out there because we need it to keep the economy going. We need it to be able to hand, the $1,200 to every individual. We need to give it out to businesses so they can keep going, which, might have been a good thing to help these businesses, help everyone so they could shut down for a while. However, now you have all this money, and that doesn't even include what happened in Europe where there are more euros that were being, quote, printed. They were being put out there to help their countries. So inflation basically means I'm going to pay more for the goods and services. And the thought is I'm going to pay more because there are more dollars. There are not as many goods and services. Even if there are more goods and services out there, they're probably not growing at the rate that the amount of dollars is growing. Okay, earlier this year there was a huge demand in the world for US dollars. So if we look at a supply and demand curve, there was a huge demand for US dollars. Okay, the demand went up, and so the government said we're going to increase the supply to meet the demand. That means people in the world wanted dollars. It was powerful to have cash because you didn't know what was going to happen. You didn't know where your next paycheck was going to be, if they were going to shut down your factory or anything else. So everyone sold equities and Bitcoin and gold and everything they could to get dollars because that was what you could use as a medium of exchange. That was what you could trade things for. There was a huge demand. The U.S. government said we're going to take advantage and we're going to throw out a whole bunch of dollars there to meet that demand. Now at some point, the demand is going to go back to normal, but the supply is still there. They're not going to pull them out of supply. So that's where you get inflation. That's where you get the fact that my money doesn't buy as much. So what do you do in that case? What do you have to have in your portfolio is you want to have some sort of inflation hedges. And an inflation hedge is something that is usually in some sort of finite supply, because if you have more dollars and finite supply or known supply or smaller supply, then the value of this in relation to this will go up. More dollars are going up, finite supply stay the same, means the value of this will go up. So some of the inflation hedges are real estate, gold, and now there's crypto or Bitcoin, to be more specific, okay? So real estate is an inflation hedge because there's only so much real estate, right? They don't make any more land. Now we can build, of course we can build condos, apartments, whatever, they go up into the sky, but there's only so much. So if you buy real estate, what you're saying is the value of this is going to go up as inflation goes up, because if I buy an apartment building and I'm charging rent, well, I can increase the rent every year to keep up with inflation because I think people are making more money and they're going to be able to pay me more, so the real estate can go up. Plus the value of that real estate goes up because people are just going to have more money to be able to buy. So if I buy a house for $100,000 this year and inflation goes up, people are making more money, well, they're going to be able to pay more for the house next year. On top of that, interest rates keep going down. They're going to want to pay more for the house now because they get to extend those payments into the future. So real estate is potentially an inflation hedge. Gold is an inflation hedge that Jim Cramer talks about quite a bit. He's a gold bug. He buys a lot of gold. And again, gold has a pretty finite supply. We keep finding more of it, but it is hard to get out of the ground. It's not that easy to find. On top of that, there's been an entire financial ecosystem built around gold that we've known about it for years, and it's become its own entity. It's become its own inflation hedge. It's got its own economy almost. Gold has a certain value. There's a certain amount of gold, and so when you add more dollars, the value of gold goes up because we're not bringing gold out of the ground at the rate that we're printing dollars. So gold becomes a good inflation hedge. And then there's Bitcoin. Bitcoin, of course, we know only has 21 million that will ever be printed. We'll talk about that in a moment. So, going back to your inflation hedges, real estate can be a good one. The problem is it can be expensive to buy. It's very illiquid. You can't necessarily get out of real estate if you want to, but it can be a good inflation hedge. You have to know the right people. You have to be able to go through the process, maybe get approved, maybe get a loan, whatever it might be. So real estate can be a very good hedge, but again, very illiquid when it comes to being able to get out and get into cash. Gold is a very good inflation hedge. It has a very liquid market. I can sell gold on different markets very easily, and there are all different ways I can gain exposure to gold without actually owning gold. So I can get a gold fund. I can buy a company that mines gold, which I believe Warren Buffett just did. Bought a mining company, so now you're subject to the operations and the management of the company, but also the price of gold, because obviously it's like buying an oil company, right? If the price of oil goes up, the value of the company will probably go up. Same with gold. Or you can just buy gold. Okay, and the problem sometimes with buying gold is gold isn't light. So if you're physically going to buy it, then you have to store it. So you have to pay to store it somewhere. That can be in a safe deposit box. That can be you can pay someone to hold and store your gold for you. You can essentially just buy it like an accounting entry, and someone will say, okay, we have we have $100 million worth of gold sitting in our vault. You now own $1,000 worth of it. We'll just make an accounting entry, right? Where they just know how much you own, but you have to pay a fee for that. You pay for that. So you don't get to 100% participate in the upside. There's a cost to it. If you just want to buy, coins or gold bullion or something, you go put it in a safe deposit box. Now, the problem with it is it's not highly liquid in that you can't just necessarily go to your safe deposit box 24/7, right? They're not open every day, and take out a bullion and go, look, I want to pay for my meal with this. Or I want to sell it to someone else for $1,900 an ounce because that's what it's going for, and just give me my $1,900 and here's a gold bullion, right? You have to prove that it's real gold. You have to find a market for it. You have to find someone who actually has the cash to buy it. So it's not that easy. Now, it's relatively easy in that there are ways we can check for it, but it's not 100% easy. And as Jim Cramer points out, it's not that easy to pass to my kids, because if I die and I got all this gold bullion stored in a safe deposit box, then you got to say, okay, you have to take my death certificate, you have to go to the bank, you have to prove who you are, then they go with their key, you go with your key, and you take these bags and bags of gold bullion out, and you're probably going to get robbed in the street with all this gold, right? And you got to figure out a way to sell it. So it's not new and cool and tech. Then you have Bitcoin, right? And for Bitcoin, I'm going to kind of erase this, but you see where we're going with the inflation hedges. These are really, gold is a long time utilized inflation hedge. It's kind of the, no pun intended, it's the gold standard. Like that's how we measure inflation hedges, because we think that there's a relatively finite supply of gold. And we're not finding it that quickly, and it's got a big market, and you can usually borrow against it, things like that you need to have an inflation hedge, to have an asset like that, and it has gone way up in value as the government has printed more money. So it's got that going for it, but it's got some downsides in that. Again, it is expensive to store, it's hard to transfer to next generation, it's sometimes hard to sell, you don't want to walk around with a whole bunch of gold. If you up and decide to move to Europe or Central America or something, it's hard to kind of take your gold with you, right? I mean, that's a whole event there. So now we have Bitcoin, which they talked extensively about. So Bitcoin, of course, we want to talk about, we have a greater supply of dollars, so we have more dollars and finite supply of whatever the asset is, right? Now, Bitcoin will only ever have 21 million. That's the most Bitcoin there will ever be. You can't get much more finite than that. And it's provable. You can go look at the Bitcoin blockchain, the white paper and everything else, and go, there will only ever be 21 million. Right now there's 18 million, whatever, 100,000 of them out there in the world right now. Okay, so it checks that box. There's only going to be a certain number of them. Now, you can also, it's verifiable, right? I know at any point how many Bitcoin there are. I know at any point how many I own, you own, whatever else. If you tell me your address, I know exactly how many you own, right? It's storable. It is, obviously, it is transferable. It is malleable. I can take it with me wherever I want to go because I just keep it in a hard wallet. It's very easy to transfer anywhere, or I can pay someone else to custody it, right? I can pay the bank, I can pay Gemini, I can pay BitGo, whoever else it is, to kind of hold my Bitcoin for me, and we can make sure that no one else is really able to take it. Okay, and there can be insurance on it. So it's got those going for it. Now, you might go, well, it's been highly speculative and volatile and such. Well, some of that volatility has died down a bit. And the reason is, and the reason why it's not as speculative is, at some point it became this asset class. And that's really important because now there is lending built around Bitcoin. That's really important because people who hold it go, look, what if I want to utilize this? What if I want to get money from it without selling it because I still think it'll go up in value? What can you do? Well, I can get a loan against it now. There's a whole ecosystem around that. There's a whole derivatives ecosystem. Right, so I can hedge the value of my Bitcoin. If my Bitcoin goes up in value, and I go, look, if it goes, if it goes from 10,000 to 50,000 and back to 30, well, I want to capture some of that gain. Well, what do? When it gets to 50, I buy a hedge at 40, right? I buy a put option at 40, and I say, look, I can sell this to someone else at 40 if it goes down. So there's derivatives around it. There's a whole ecosystem around it. It's starting to be well received and understood that for all these reasons that I can keep it safe and I can keep it secure. There's insurance that will insure the custodians like Gemini and BitGo so that if they have hacks or something like that, I can be made whole. There's insurance that will cover that because we've gone to this point where it's essentially its own asset class. This isn't necessarily crypto, this is just Bitcoin. Other cryptos have their own economics, tokenomics, whatever you want to call them, that their valuation is different. Bitcoin there's 21 million of them that will ever be created. The amount of dollars is going up. There's a finite supply of Bitcoin, so the idea is to keep Bitcoin as an inflation hedge. If I'm going to need it later, if the price of Bitcoin goes up because there's all this inflation, I can sell my Bitcoin and I can pay for the stuff I need to pay because the dollars I had in my bank account aren't worth as much, but my Bitcoin takes up for that, right? So again, if I have dollars in my bank account and I have Bitcoin in my Bitcoin wallet, and I have $1,000 here and $1,000 worth of Bitcoin here, right? And inflation kicks in 5%. This becomes $1,050. But Bitcoin, because of that, goes up to say $2,000, and the price of that loaf of bread is $1.05 now. Went from $1 to $1.05. I can take the dollar from here, and I can take the 5 cents from here, right? I've taken care of my inflation over here with the Bitcoin side. This is taking care of my inflation because this is not worth quite as much. Okay, so that's a little bit about Bitcoin. Now. Pomp also referred to some of these studies that show that if you hold it in a portfolio, so if you're not saying I'm just going to hold it for an inflation hedge, but I want to hold it because it is non-correlated. That means it is it does not necessarily move exactly up and down with the equities markets, right? So, and we talk about this in another video. It is non-correlated. And that basically means it doesn't move up and down with other equities or other parts of the market. Now, lately it kind of has, because it's a risk asset, because it's about inflation, it's about the dollars that are going in. But Bitcoin is Bitcoin. It's not like Tesla or Apple or anything else. You're not subject to the management of the company or anything like that. It is just the amount of Bitcoin that's out there. It's non-correlated. So if you put it in your portfolio and you rebalance regularly, you say it's going to be 5% of my portfolio all the time. So you have 95% over here, 5% over there. Now let's say the value of Bitcoin goes up, and so now it's 8% versus 92% of the rest of your portfolio. You rebalance. So you get this back to 5, you sell some of this, you put it over here, get this back to 95. Now this goes up to say 97% because the value of equities goes up in relation to Bitcoin. This is 3. You sell some of this and get back to Bitcoin. This type of portfolio performs better than if you had a portfolio that was 100% in equities or 100% in a 60-40 equity bond portfolio, because you have something that is not correlated and you get to take advantage of that volatility. Okay, so that's another potential reason and something else they talked about and what we wanted to discuss. Now, let's say that you do make the decision that you're going to buy Bitcoin. I want to buy Bitcoin. What do? One, you go get educated, you figure it out, you talk to your financial advisor if they understand it. If they don't understand Bitcoin, tell them to talk to us, because we'll help them understand Bitcoin and crypto and everything else. That's kind of what we do, is we educate you and we educate financial advisors so they can make it part of their practice. That's what we're trying to do, so that financial advisors can help you with this. But if you don't understand it, then you go to an exchange, or you go to Cash App or something, and you go through the KYC. They got to know who you are, know that you're a legal person, and know that you're not doing this for nefarious purposes or anything. And you go buy it on, let's see, Coinbase, Gemini, what did I say, Cash App, whatever it might be. And then you figure out how you're going to hold it. And the way you hold it might be in a hard wallet. You go, I just want to hold this, for a long time, for good. I'm going to be a holder. I'm just going to hold it in a hard wallet. Again, we talk about that, and talk to your advisor, or talk to someone who knows, and we're happy to discuss that with you. You might hold it in a hard wallet. You might hold it at someone like Gemini or Coinbase custody. They're going to take on some of that role of the custody, of making sure that the insurance is behind it, making sure that if they get hacked and they lose it, that you don't lose your money. So that's a little bit about how you go about buying the Bitcoin, or buying crypto and storing it. And again, Bitcoin is kind of separate from other cryptocurrencies a lot, because it just has this, here's the supply, we know everything about it. It can be used for other purposes. It can be used to transact business as a medium of exchange, but really what a lot of the investors are looking at it as is an inflation hedge. So that's a little bit about this podcast we saw, what we saw on YouTube, what we listened to between Jim Cramer and Pomp. We just wanted to explain some of it. Hopefully we kind of got it all in there. We explained it in a way that you understand. If you need it, email us, info@interaxis.io. Leave something in the comments below. Find us on Twitter @interaxis8. Of course, subscribe to the channel here, and we hope to see you in the next video.